This is an introduction to the first financing video where we actually go through the formulas. Okay, now on the top here, I mentioned a couple of things. First of all, it's tricky to know when you actually have to raise the financing or you're going to pay back the debt and provide dividends for the equity. So that's one of the things that's covered in this video, and the it says you have to go downstairs to the cash flow statement. So you start with the financing analysis. Maybe I'll call it a financing needs. Okay, and you go down to the cash flow statement and see, well, how much do I have to get? Okay, just a minute. You know, if you're doing this, perhaps there's going to be another video, by the way, on making these horrible functions not so disgusting. The In terms of being heavy, heavy for the model. Okay, and then we say, well, you know, if there's some additional amount to be funded, we include that. And then we say, well, how much of the funding comes from equity and all that, and that allows you to really get started with the analysis. And in this video, you're going to go through the debt schedule, the a little bit, not complete, on the IDC and um, fees, and then a little bit on the cash balance and down through the profit and loss statement. And there's the main trick really is just linking things up. So this isn't that much of a video. Again, it's kind of boring. Uh, if you want, you can look at the final result. Maybe that's a little bit better. Okay, that's enough of that. Okay, this video is going to be about. Oh, is that exciting enough? Do I sound excited about this? Good. This video is going to be about filling in some of the financing stuff. Huh! How exciting is this? Now, the real exciting thing is that I went and yet another change. You almost this generic macros has another change. So what you can do is look at this is the maximum kind of number of rows you have to look down. Now it's going to take a little bit longer when you look all the way down to 450 rows. So if you press Shift Control C, you can see it's taking just a little bit longer. Well, maybe a lot longer, I don't know. Okay, but at least it will go down and it will find everything. Oops. I think that's something to do with the fact that I just finished this. But so we go all the way down to the balance sheet and the cash flow, and we go all the way across, and we have all these things that come from the other sheets. Okay. The way I really test this stuff out sometimes is use it in my classes, and when I try it on some other people's models, we had a little bit of a problem once on this. Now, okay, we're going to start this thing, okay? So the first thing is we go down to the cash flow statement, and this negative cash flow we have down here before financing, after EBITDA and after CapEx, that's the amount we're going to um, we're going to finance. Now, eventually we might have some circular reference with this, frankly, because of the taxes, but um, uh, uh, we'll work on that later, okay? And then this was a negative number, so the amount we finance is a positive. Now, if you make a negative of a negative, that's a positive, and you take that positive and compare it to zero, you only have a positive. And then the next thing, uh, uh, the, now, Uh, I'm just listening to something about de-Googleizing the internet. Oh well. Uh, they shift control. Whoops. Let's press shift control 1. Now, so this is just the amount of the total funding we're getting for equity, and we also have some equity from. This is the equity from required financing. Now we might have some equity from just developing our company itself. That could be an important item. So if you press Alt equal, we'll get the sum of those two. Now, every single time we put opening and closing balance, and our financing from the debt is just the amount of the equity, the total we need minus the equity. That's a common kind of um, assumption. This fixed payment would be very tricky if we want, because every time we issue it, we'd have to go forward 10 years and compute a macro to do that, or a function. There's no way to really do that in a simple way. So instead, we'll get the amount from the cash flow sweep. Now, this cash flow sweep cannot be calculated until we go through the cash flow statement. So there are a number of items like this, both in a corporate model and look at what a ridiculous cash sweep. So we can't get that until we're finished. Now, I suppose, I'm going to change the formulas and make it manual. And the thing that's slowing us down is that big function. And we press this one and add the financing minus the fixed payments minus this. Okay. And then we're going to just press F4 a couple of times, 3 times, just so we show the interest rate. It's not necessary, really. And then we take the amount of the interest that we actually pay to the banks. And the next thing we do is we take this, and this is just accounting allocation. We allocate some of this interest to IDC. And then we can take this total minus the amount we allocated to IDC. That's what we're going to record as an expense. This one's recorded as a CapEx. They're both a subtraction from cash flow. It's really just an allocation. It's a painful allocation, though, and it affects taxes and everything else. Then we can compute the fees, okay? And the fees are the amount of the financing times this. Now, this is a very dangerous area for circular references. Okay, and then we have an opening balance equal to closing balance for the construction work in progress. Now, the CapEx that we can go a few places, but it's probably best to go through where we really compute them. Here's the net CapEx. But then the plant placed in service, remember that's down here. We could get this from here, or we could go up and find this. This was in, again, the capital expenditure section. We can find out how much actually went into cost of, this was the amount that was actually placed into service. Okay, that happens after the CapEx. And then we have this minus the thing. The total construction work in progress is here, and then the total plant balance is this construction work in progress plus the amount that we placed in service. We just did in the last section. And then the percentage of IDC, we can just take, well, the construction work in progress and divide that out. Now, whenever you do this, you need to press I307. Okay, and if you don't like it saying false, you can multiply it by 1, I guess. Okay, and then we can press Shift Control P. And then the amount that's not, we'll do the same. No, let's just put 1 minus that. Okay. Now the minimum cash balance is the amount. Well, this we're just going to show people what this is. Okay, and we can do this. I'm saying we again. We take this 5% and just multiply it by the revenues. The issue is to assume that a certain amount is just required. Then I take the opening balance right here, and the minimum minus the opening balance is the shortfall. Now, we don't really know how much shortfall we're going to actually have, because if we don't have any cash flow, we're not going to be able to get any of that and put it in a cash account. So when we find the amount, I'm going to keep saying I can't stop it apparently. The amount of cash that actually is going to be put into the account comes from the cash flow statement, just like the cash sweep. And this says right here, this says how much cash is used to actually fund the minimum. The amount that we take away, it turns out I don't think we need. I left that, I'll leave that and subtract it anyway. And this is going to go on the balance sheet. And then we have the percentage of the interest income, which is adjusted to be adjusted to be, that was a bad sigh, to be monthly. Why is that a percent? Oh no, this is just F4 because I'm going to show this, and then I'm going to multiply this by the opening balance again, assuming that every single item of cash you have, comes from the it comes right at the end of the month. Now, I think, well, let's go ahead. Let's see. Yeah, why not? I was debating whether to stop now and make a second video. I think it won't be that disastrously long, so we'll have the opening balance equals the closing balance. Now this IDC and fees, I'm going to leave out just for a minute. This is this plus this. Okay, and the reason is this is such a dangerous place of circular reference happening. Now let's just take the straight line depreciation rate, or any depreciation rate, and then multiply that by the opening balance, just like we did for everything else, whatever, just like I did. And then I go back to this one and add the amount of depreciation, and then again, this has some retirements. So this was this issue of accumulated depreciation having retirements. I'll go up and get the revenues now. I'm trying to say this correctly. Revenues before uncollectibles, and then go and get the uncollectible amounts that's accrued. It's just an accrued. We don't know how much we actually haven't recovered. The reason in the model, then, when we actually collect it in accounts receivable, I just subtracted that. The amounts receivable collected is only after the uncollectibles, so the cash is never collected. Okay, you could make all sorts of fancier things, I guess, saying that we estimate the amounts of uncollectibles and don't actually collect it, and then go to the right section, this is a key thing, is that once you've had a very nice organized and structured model, you should find things. Then the net revenues minus all the operating expenses, and I haven't done anything for the marketing costs yet. The depreciation was computed up here in this free cash flow section, but we couldn't really compute the depreciation on all of the plant in service. I mean the you know what I mean, the IDC and all that stuff, until we've done the debt balance. So I split the depreciation into two sections, and then you subtract the two, and then go to interest expense. Remember, this is accounting now. The interest expense was right down below the debt balance, and it was the last one after that. It's not the interest we pay. I can say that because we're the company, and then the interest income is down here, and I've got all the things as positive numbers, so we subtract that and add that. Now, this is what I was a little worried about. On the net NOL, you start by making the opening balance equal to the closing balance. Oh no, I've got a phone call. Just a minute. I've got to take this. Okay, finished with the phone call. Now, what we do is put a maximum of a minus of this or 0. Switches the minus to a plus, makes it a positive number convention, and we only carry forward when we have a loss. But then, if we have a positive income, okay, then we can only use as much as we have in the opening balance. So you put a minimum first and then a maximum. I just think this one's a way to explain use of minimum and maximum a lot. And then we add this, subtract this. To be a little transparent, we say, okay, what we do is we take this minus this. This is how our taxable income is affected. We add back the stuff. So if we have negative taxes, and then we can have I didn't finish the sentence, but whatever. And then we add this to get adjusted EBT, and then we press the F4 button and multiply this by the opening. Then we take the earnings before tax and then subtract this tax. And then we're finished with the profit and loss statement, and I'm stopping the video. And it wasn't so bad, it was only 15 minutes. Okay? It took us about as long just to explain all the accounts.